Hello, very good afternoon to all, and welcome to a brand new week ahead. I'm Kelvin here. Welcome to today's Daily Dose of Market Insights. Today will be Monday, the 24th of February 2025. So, as usual, before we jump straight into today's gist of Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, let's have a quick recap what has taken shape on last Friday in terms of key economic data, their impact on the various broad-based cross-asset classes, as well as key events that has taken shape over the weekend that potentially has also a spillover impact in today's early Asia session as well. So let's start on last Friday key economic data releases first, especially this data has a negative impact on the major US stock indices. So what is this data I'm referring to is in fact the this particular data here, which is the preliminary S&P 500, we call it the flash services PMI data compiled by S&P Global Market. So we know that in US there are actually two kind of PMI data that market tends to focus on. One is the ISM services and PMI and manufacturing PMI data. The second one will be the S&P Global Services PMI data compiled by two different organizations, but they do have a potential significant impact if either one of them has a kind of a miss or a kind of a very significant bit in terms of market consensus. So you look at I want to more concentrate on the services side of the story is that we know that why services is important because services contribute to close to 3/4 of US economic growth, and the preliminary reading, the flash reading on the services PMI for the month of February in US has came in below expectation. So market is expecting it to be 53, almost on a similar growth trajectory that was printed in January, which is 52.9, but it came in below expectation and also came in below 50 level. So for PMI data reading, regardless of which country you look at, any number that is below 50 represents a contractionary reading. So if you look at the trend of the S&P US Global Services PMI flash data for February, there was actually a steep drop on the February figures. Okay, give me a minute, let it run. Okay, so what you could see over here is that there's this steep fall off in the February figure to below 50, and this headline number of 49.7 is actually the first contraction in the services sector activity in almost 2 years. And if you look at the 3-year trend, very clearly it starts to break down this kind of a ascending trend line that was previously in place since July 2022. All right, so that actually kind of smoke market a reaction on the major US stock indices. So we start to see the major US stock indices, all four of them close in the red. S&P 500 down negative 1.7%, the Nasdaq 100 down negative 2.06%, the Dow Jones down negative 1.7%, and the worst hit was the Russell 2000 down negative 2.4%. So what you see over here is that markets in the since last 2 weeks or so, especially the US stock market I'm referring to, is that they tend to strike off this stagflationary fear in the market, which has been kind of a highlight in my previous daily dose, where we start to see the Nasdaq 100 and the SPX continues to churn fresh all-time high, but not the Dow Jones and the Russell 2000. And because of this ignorance of this stagflation fear in the US stock market, any particular leading economic data, which is one of them is the PMI data on Friday, the services PMI data being compiled by S&P Global organization, came in below expectation, and it started to show almost in the first contractionary reading in the last 2 years on the services PMI, that could easily spark a negative feedback loop in the major US stock indices, which we actually start to see on last Friday. So I know that most of you are wondering what are the key levels to look out for today. So with that, bear in me for a while. So I'll touch that when I cover the short-term intraday technical outlook on the Nasdaq 100 and the Dow Jones Industrial Average thereafter. All right. And another data that has taken shape over the weekend on Sunday was that almost came in kind of within market consensus is that German election, the federal election was actually more or less concluded on Sunday. Yes, the votes are still counting, but based on exit polls, market is now looking at the winner to be this guy called the where's this guy? Yeah, over here. The CDU-SU block over here is projected to win 28.9% of the votes. And this guy here is more like a kind of a conservative party where this party embraces more fiscal spending. And one thing positive to the market over here is that this CDU CSU block, which is projected to win by 28.9% of vote, despite the fact that the far right AFD party came in second, and the current chancellor, which is the prime minister of Germany right now, his social democrat is coming in third, but CDU CSU, the party that is expected to win, the leader Marx, he himself has pretty much highlighted that he will not join a coalition with the far right AFD party, and potentially the coalition might be formed together with the current the outgoing chancellor Social Democrats Party or the Greens. All right, so that also be a positive sign as well, because any coalition party that has AFD, the far right AFD party in, which is pretty much negative for Eurozone. Why? Because this far right AFD party in Germany advocate for a break out of the Eurozone monetary policy union, means they are actually anti-euro. So market actually reacted very positively to it, where we start to see the euro dollar gaining strength today in today's Asia session, and we start to see continuation of the dollar weakness being spilled over from last Friday. And the one that is much more pronounced based on the 5-day rolling performance is the dollar yen. So the dollar yen also plunges to actually break below the 150 figure level and hit right at our support level, which I highlighted on Wednesday before I go for a short break over that. So later I'll highlight what are the key levels to look out for in the FX market, and as well cover the dollar yen as well, which has been facing pretty much negative feedback loop spiral significantly on a shorter term basis. All right, so then on top of this, these are the key events that has taken shape over on Friday and over at the weekend. And one thing I want to highlight on this intermarket dynamics chart before I touch on the intraday technical outlook is this particular chart about inflation expectation. So this inflation expectation, for those who followed my day, those pretty much closely, is this dark blue line and the light blue line. So these are break-even rates. Okay, so these break-even rates are being calculated based on the prices of market transacted prices of US Treasury protection securities, inflation protection securities, which is TIPS in short. And for that, we are able to infer market participants in this particular area of instrument, which is the TIPS, US Treasury Inflation Protection Securities Instrument, how they view inflation will be 5 years from now and 10 years from now. So take it as a forward-looking gauge. All right. So based on the 5-year, which is a medium-term perspective, 5-year inflation expectation, the break-even rate has risen rather very steeply since the start of this year. So now it's at 2.61%. So this 2.61%, if you look at it across the past, is the highest since February 2023. So that's about close to a 2-year high, and it also starts to lift away from the Fed preferred long-term target of inflation trend to be stable at 2% in US. So what it implies over here is that if the US Federal Reserve officials is watching this particular uh, inflation expectation that is being priced by the TIPS market participants, they will be not so inclined to be dovish, right? Because they may, if they be rather dovish, they may further spike inflation expectation to go higher. So they got to actually manage this inflation expectation that is being placed on the 5-year break-even rate. So going forward, in my own opinion, they will potentially be able to talk down this higher levels of inflation expectation, and that potentially could be negative to the stock market, because the stock market also tries on liquidity as well. But what's interesting over here is that the 2.5 weeks of dollar weakness is coming very close to a inflection level by looking at the dollar index. Yes, in short term we may continue to see this dollar weakness, but now is since hitting the high on 13th of January. It has been trading in this corrective pullback, and this corrective pullback sequence is now coming very close to a key medium-term support at 105.50. This green line here, I highlighted my chart. This is the US dollar index over here, and also correspond to the 200-day moving average, and as well as this former symmetrical triangle range configuration. Previously, it was a range resistance broken out on November, retested on 5th of December, and right now looking for another second retest of it again. So right now, the US dollar index that is sliding downwards due to this 2 week of corrective pullback is coming very close to a inflection point, and also with the 5-year US inflationary expectation that is going up higher and higher, there could be increased risk that the US Federal Reserve will try to talk down on this inflation expectation. That means they try to potentially give out speeches that are less dovish in terms of their monetary policy guidance. So that could also potentially see a bit of dollars strength support that potentially could come into place. And do not forget, this week we also have a key data that is coming in that may impact the US dollar major pair as well, which is coming close to the end of this week, which is Friday, the core US PCE inflation data, which the Federal Reserve officials has already mentioned. This particular PC data pays more importance than the CPI data. Right, something to take a look out for. So this is the intermarket dynamics and fundamental I want to share with you all from a much more it may actually start to form from a longer term horizon, all right, from a multi-week to multi-month horizon. So now with that, now let us now jump straight to the intraday shorter term horizon for today. That I will share with you all on the major cross asset classes, starting with the FX market first. So with that, let me expand my screen so that you guys could have a better view on the chart and the levels to watch. Right, so let's start with the euro dollar. Okay, so on the euro dollar, still recall before I went for my break, we will have that bearish bias, and the bearish bias managed to hit the support level at 10440, then followed by 1.0360. All right, these two support levels, so it managed to hit, and it shaped a rebound off on Thursday, and where it bounced off from the 20-day moving average. All right, from here. So with that, we do expect on the intraday basis the continuation of this short-term intraday bullish trend, or I'll put it a short-term intraday corrective rebound sequence to extend. So right now it hit the resistance level at 1.0530, which is the minor swing high area of 27th of January. And what we could see over here, potentially as European session open, there could be some form of a minor pullback that could take shape. Why? Because the RSI also try to actually hit the overbought region and starts to exit out from it, okay, upon hitting slightly above 70 level mark in today's Asia session. So with that, there's a bit of overbought condition that has been depicted on the short-term basis or short-term intraday basis. So there could be a risk that during the European session, there could be a minor pullback taking shape. So minor pullback, first support level to watch over here will be this zone here. Okay, at 1.0485. So as long as this pullback didn't surpass below my short-term pivotal support that I have for today at 1.0440 level, which is coming pretty close to the 20-day moving average. Very clear congestion level previously that was formed on 5th of February. And if you will do the Fibo retracement of this push up from the test of the 20-day moving average on last Thursday all the way up to today's Asia session high, it also constitute to the 76.4 Fibo retracement level as well. So as long as this minor pullback didn't surpass below 1.0440, I don't want to put it so tight at 1.0485 just in case of any whipsaw. We will still maintain that intraday bullish bias for the potential ongoing counter trend rebound sequence to extend above 1.0530, potentially sees the next intermediate resistance coming in at 1.0565, followed by 1.06 figure level, which is the minor swing high area of 20th of November and 6th of December last year. Only a push down and a hourly close and a break below 1.0440 will invalidate today's intraday bullish bias to kickstart another round of potential choppy downside movement in first step first, to expose the next near-term support level at 1.0360. Below it exposes next support level at 1.0330. So that means potentially it may start to float back down towards the lower limit of this kind of triangle-like range configuration that may take shape on the euro dollar again if 1.0440 short-term pivotal support for today is broken to the downside. Right, so that's for the euro dollar. Onwards, next will be its cousin, the sterling dollar. So the sterling dollar also try to shape a push down on last week over here on last Wednesday, where it hit almost our first support zone at 1.2570/2540 before rebounding off. All right, on last Friday. So what I could see over here is that momentum still rather strong right now on the hourly RSI. So the hourly RSI hasn't hit the overbought region yet for now. So with that, potentially there may be a bit of minor pullback, but less of a steeper minor pullback. So I'll be using last Friday minor swing low area that was broken out and retested in the previous minor range resistance from 14th of February to 19th of February. Now turns into a pullback support on last Friday. So 1.2627 will be my short-term pivotal resistance support level, pardon me, on sterling dollar. I repeat again, 1.2627 will be my short-term pivotal support on the sterling dollar. We will flip to an intraday bullish bias for a potential extension of this ongoing corrective rebound sequence on the sterling dollar. Next near-term resistance level to watch, 1.2720. Above it potentially exposes 1.2780/2810, which is also confluence with the 200-day moving average, acting as a similar resistance zone as well. Only a push down and an hourly close below 1.2627, pardon me, short-term pivotal support that we have for today will invalidate today's intraday bullish bias to see a choppy downward movement, exposing the next near-term support in first step at 1.2570/2540. Below it sees 1.2480, which confluence with the closely with the 20-day and the 50-day moving average, acting very closely to this next support level at 1.2480. All right, so that's for the sterling dollar using 1.2627 as my short-term pivotal support, and we will flip to a intraday bullish bias for a potential extension of this ongoing corrective rebound sequence on the sterling dollar. Right, onwards next will be the Asia Pacific currency dollar pair, starting with the Aussie dollar. So the Aussie dollar continues to be trapped below this key resistance level at 64 figure. So in today's Asia session, price tried to rebound, and what we could see over here is that it starts to form this kind of shooting star candlestick, an hourly shooting star candlestick, indicating a bit of lack of hesitance in the bulls in today's Asia session for now. So with that, I'll be still using a 64 figure level, no change, as my short-term pivotal resistance for today. If this level is not surpassed to the upside, potentially there could be a slight downward bearish bias on the Aussie dollar to revisit 63.30 figure level, 63.30, pardon me, 63.30 level that was being tested on last Thursday and managed to survive. Only a breakdown below 63.30 level potentially could expose an extension of a intraday weakness towards 63 figure followed by 62.70. All right. However, if price starts to have an hourly close above 64 figure level, then today's intraday bearish bias will be invalidated to see a squeeze up towards 64.30 and potentially even 64.70 next, which is the congestion area of 3rd of December and 10th of December last year. All right. And also, if I were to draw a ascending trend line looking from the lows of 12th of December all the way up to here, that was being supported. Okay, the upper limit also is coming close towards 64.70 as well. Right, so that's for the Aussie dollar. Still using 64 figure level as my short-term pivotal resistance to maintain that slight intraday bearish bias. But first support level to watch will be 63.30. Only a breakdown below 63.30 may expose further intraday weakness. All right, so that's for the Aussie dollar. Okay, onwards next will be very interesting. Will be the dollar yen. So dollar yen, before we went for a break, we were bearish and the price action hit the support level at 48.80/70, and also the lower limit of this medium term uh, descending channel that is in place since 10th of January. All right, it's close to about more than, yeah, 10th of January is coming to more than slightly a month. So view that as a medium term. Okay, so what I could see over here is that it hit the lower limit of this medium term lower bound, the medium term lower boundary of the descending channel. Also come close to our support level that we highlighted on last Wednesday before I went for a break. And what's interesting is that the hourly RSI has started to shape another bullish divergence. Right from here, there's a bullish divergence. So what I could see, oops, over here, price action do a lower low, hit the lower limit of this support level of the lower limit, of the descending channel, which is the descending channel support. Also confluence with the 148.80, 148.70 support level that we highlighted on Wednesday. That was the bearish bias support. Now we start to see a bullish divergence on the hourly RSI, so indicating that last Friday move is rather overextended and the momentum has starts to lose out. So with that, there could be a probability of a minor mean reversion corrective rebound that could take shape in this ongoing medium term to short term downtrend of the dollar yen, where all price action now is trading below the 50, the 20, and the 200-day moving average. But we know that price action has left the moving average for quite a distance, especially at the 20 and the 50. So there could be a chance of a mean reversion rebound to revisit back to the 20-day moving average in first step, and so corresponds with the 200-day moving average. But we are taking things slowly, one at a time. So using 148.80/70 short-term pivotal support level for today, we'll flip to a intraday bullish bias on the dollar yen for that potential mean reversion rebound sequence that may unfold. First resistance zone to watch out for today will be at 150.95 slash 150.70/95. All right, only above 150.90. Okay, let me put it in better writing. Yeah, 70/95. Okay, 150.70/95, only above 150.95 may see the next intermediate resistance coming in at 151.30 next over here. Only an hourly close and a breakdown below 148.70 short-term pivotal support level will invalidate today's intraday bullish bias of that so-called mean reversion rebound sequence, and that could potentially allow the bears to take a foothold to see the continuation of the impulsive downward sequence unfolding again, exposing the next near-term supports in first step 147.95. A breakdown below it sees 14710/146.90, which is a Fibo extension cluster level. And graphically, if you go back in time, over here is the former minor swing high area of 3rd of September, and 4th of October now turns in breakout and turns into a pullback support level next. Right, so that's for the dollar yen. Flip using 148.80/70 as my short-term pivotal support today due to the bullish divergence that's being seen on the hourly RSI and the overextended move that has left a big gap between the 20-day moving average and the 200-day moving average in the last 2 days or so. We will flip to an intraday bullish bias for a potential minor mean reversion rebound that may take hold using 148.80/70 as my short-term pivotal support. on the dollar yen. All right, so with that, let us now focus our attention towards the major stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. So the Hang Seng Index did a minor pullback, right exactly at our resistance level that we highlighted on Wednesday. That was almost met as well on the last 2 days of Thursday and Friday at 23,830, give or take. It printed an intraday high of 23,707. So what we could see over here is that despite this ongoing pullback that has taken shape, the hourly RSI prior to this pullback taking shape after hitting the overbought level on Friday did not flash a bearish divergence. Okay, it does show a similar high on the RSI and similar higher high on the RSI and similar higher high on the Hong Kong 33. That means, i.e., whatever weakness that we are seeing right now could potentially only constitute a minor pullback rather than a change of trend. All right, over here. Right, so this ongoing bullish trend still remains intact from the minor bullish trend still remains intact from the low of 3rd of February. So what I could see over here is that I will have a tighten key short-term pivotal support level for today to maintain that intraday bullish bias for the Hong Kong 33 at 22,880. So what's this level? Minor swing low area of 21st of February, confluence with this steeper minor ascending channel that I drew from the low of 3rd of February as well. So as long as this minor pullback didn't surpass below 22,880, we would still maintain that intraday bullish bias on the Hong Kong 33. First resistance level to watch 23,830. Above it potentially sees the next resistance zone coming in at 24,190 slash 24,510 next, which is a Fibo extension level. All right, clustering level. Only hourly close and a breakdown below 22,880 will invalidate today's intraday bullish bias to potentially kickstart a deeper corrective decline sequence, exposing the next near-term support level at 22,470, followed by 22,130 next. Right, so that's for the Hong Kong 33. Next up will be the Nikkei 225 or the Japan 225, we call it. So for sure, for heads up, the Japanese cash stock market or the cash stock market is closed today. So whatever price action that we see right now is taken from the futures, the Nikkei 225 futures that is being quoted on Globex CME. So lower liquidity. So what you could see over here is that the Nikkei or the Japan 225 plunged on last Friday as well after a failure to actually surpass above the 20 and the 50-day moving average. So what you could see right now potentially is that it may start to revisit the lower limit of this major complex sideways range configuration that is still in place since 27th of September last year. Right. So with that, I would rather use a rather tight short-term pivotal resistance for today at 28,410, which is this minor ascending trend line support right now turns into a pullback resistance at 28,410. So as long as this 28,410 is not surpassed to the upside, potentially there could be a bit of intraday weakness on the Japan 225 within this major range configuration that is still in place since late of September last year. First support level to watch will be 38,140 slash 37,980, which is trying to do a bit of consolidation right here, right now. Right, so in fact, it is graphical zone here. Minus swing low of 13th of January, 17th of January, and as well as the minus swing low of 29th of November. Right, so this graphical zone here, only a breakdown below 37,980 potentially exposes further weakness towards 37,730 at it head down towards the lower limit of the 37,415. This is the key support level of that major range support level, the major range support of the complex range configuration that is in place since 27th of September last year. Only an hourly close and a push up above 38,410 will invalidate today's intraday bearish bias to see a squeeze up, revisiting the next intermediate resistance at 38,800. Above it sees the 20-day moving average coming in as the next resistance as well at 39,045. All right, so that's for the Japan 225. Now, what's up next on the German 30? So the German 30, previously we went for a break. We do have a very tight short-term pivotal support level. The pivotal support level break came down and almost hit the 20-day moving average before shaping that bullish reversal that we are seeing right now, all right, due to the outcome of the German election. So things are rather rosy in terms of technical configuration over here. Why? Because if we look at how the price action shaped the lower low upon retesting the 20-day moving average, the RSI shaped a higher low, which is a bullish divergence, all right, over here. So indicating that the downside momentum has started to abate and starts to ease off. So with that, I will use this level here, which is very close to the 20-day moving average, which is the Friday's minor swing low level at 22,130. Let me push it up here. Okay, 22,130. Okay, let me delete this. Okay, so I'll use 22,130 as my short-term pivotal support level for today on the German 30. First resistance level to watch will be this congestion here. Formerly that was broken down. That was last Wednesday Titan short-term pivotal support level 22,600 slash 714. A breakup above it, revisit the current all-time high area at 22,930 slash 23,050 in the first step. Right, so that's for the German 30. Only a push down and a hourly close below 22,130 short-term pivotal support for today will invalidate today's intraday bullish bias to see the extension of the minor corrective decline sequence unfolding again, exposing the next near-term support level at 21,690 slash 21,540. Okay, so that's for the German 30. Using 22,130 short-term pivotal support level for today to have a intraday bullish bias based on the positive technical elements that has been highlighted a while ago. Okay, so that's for German 30. Then now onwards, next will be the US stock indices, starting with the US Wall Street 30 representing the Dow Jones Industrial Average. Last Friday we were neutral. Okay, or not last Friday, last Wednesday we were neutral. And it broke down below the neutrality limit at 44,190 over here, and also broke down below the 50-day moving average as well. So with that, I'll be flipping to a intraday bearish bias on the US Wall Street 30. What's interesting over here is that the RSI has managed to exit from the oversold level, so indicating there could be some form of a minor bounce taking shape when the US session opens, but it did not have a bullish divergence. Price action on the hourly RSI continued to shape a lower low in line with the lower low of the price action on the US Wall Street 30. So with that, we will have a intraday bearish bias, so indicating lower odds of a bullish reversal, or just only a potential dead cat bounce potentially. All right, so using 43,730 slash 43,840, that will be my short-term pivotal resistance level for today, and also the 50 confluence with the 50-day moving average as well. We'll flip to an intraday bearish bias on the US Wall Street 30. Breakdown below 43,380 intermediate near-term support level exposes the next support zone at 43,120 slash 42,980, which is the 1.618 Fibo extension, as well as graphically this support area over here, and also most importantly this light green, this turquoise green line, if you go to the daily chart, is the major ascending channel support from the low of 25th of October 2023. Right, that's pretty much important of this support zone here, pretty much close to it, 43,120 slash 42,980. However, only a push up and an hourly close above 43,840 will invalidate today's intraday bearish bias to see a choppy upward movement back towards 44,190. Next near-term resistance level to watch. Above it sees 44,640 next. So that's for the US Wall Street 30, using 43,730 slash 43,840 short-term pivotal resistance, and we will flip to a intraday bearish bias for today on the US Wall Street 30. Next up will be the Nasdaq 100. So the Nasdaq 100 also can't break up and broke below our short-term the pivotal support level that we have on Wednesday, and also break below the 20-day moving average and managed to survive on last Friday at a 50-day moving average at 21,570. So with that, the hourly RSI starts to now exit from the oversold level, but also no bullish divergence as well. All right, so with that, potentially there could be a minor bounce heading towards the opening of the US session, or we call it a dead cat bounce potentially, using 21,930 as my short-term pivotal resistance level. This is very clear. Why? Because once this level broke down on last Friday, we see this three bearish Marubozu candlestick that take shape. That means there's a steep sell-off. So this is a very key psychological level that opened the floodgates for the bears on last Friday. So this will be a very key psychological level, 21,930 short-term pivotal resistance level. As long as this potential dead cat bounce didn't surpass 21,930, we will flip to a intraday bearish bias on the Nasdaq 100. First support level to watch will be 21,570. Below it exposes the next support level at 21,400 next. Only an hourly close and a push up above 21,930 will invalidate today's intraday bearish bias to see a squeeze up to revisit last Friday's minor swing high and last Thursday minor swing high at 22,160 next. All right, that's for the Nasdaq 100, and also sum up the intraday technical outlook on the major stock indices. So now let us focus our attention now to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, no change as it continues to consolidate within this minor ascending steepened channel, which is the dark lighter green or the brighter green one from the low of 28th of January. Let me put it this year, okay, darker. All right, so with that, the hourly RSI also starts to shape a higher low as well. Okay, there's a higher low over here on the hourly RSI, and it's still holding above the 50 level mark. So with that, I will have a tighten key short-term pivotal support for today at 29,004. So 2904 my tighten short-term pivotal support on gold XAU/USD, still maintaining that intraday bullish bias. First resistance level to watch will be last Thursday fresh all-time high area at 2,944, 2954. Above it, potentially sees the next intermediate resistance coming in at 2,990, 3,000 psychological level, which is a Fibo extension clustering level as well, 2 times and 0.618. Only hourly close and the breakdown below 2,904 will invalidate today's intraday bullish bias on gold and potentially kickstart a minor corrective decline sequence, exposing the next near-term support level at 2,880. Below it potentially sees a steeper corrective decline to expose the next support level at 2,845 next. Right, so that's for gold XAU/USD. Lastly will be the West Texas crude oil. So West Texas crude oil on Thursday and Friday, it actually kind of challenge the pivotal resistance level that we highlighted around 73.30, 73.40 before plunging down and broke below the minor swing low of 13th of February and 17th of February, okay, at 70.60 level. All right, it broke down over here. So with that, price action seems to have be in the hands of the bears right now. So if you look at the daily chart of West Texas crude oil, very clearly it stands to form a bearish Marubozu candlestick, and the hourly RSI, the daily RSI also got rejected at the 50 level and inched down much lower and haven't hit the oversold region yet. So what you could see over here is that it could translate to more further weakness after last Friday and Thursday retest at the 20-day and the 50-day moving average, can't surpass it and shape that bearish reaction. And on last Friday formed that bearish Marubozu candlestick formation. So onwards to the hourly chart. So on the hourly chart, the hourly RSI has already hit the oversold region. So there could be some signs of a dead cat bounce again, because we know that price action don't go vertical down. Dead cat bounce resistance level to watch in first step will be at 71.35. I will use 72.06 as my short-term pivotal resistance level. Why? Because if I were to do the Fibo retracement of last Friday's sell-off all the way down to today's Asia session intraday low, the 72.06 represents the 50% Fibo retracement as well. Right, close to the 61.8, in between the 61.8 and the 50% Fibo retracement. So I'll be using a slightly higher level just in case of any whipsaw, 72.06 as my short-term pivotal resistance level. As long as this potential dead cat bounce didn't surpass above 72.06 short-term pivotal resistance, we will still maintain that intraday bearish bias after that potential dead cat bounce that may take shape. Next resistance, next support level to watch in the near term, 69.80. A breakdown below it exposes 68.80, which is the minor swing low area of 11th of December and 20th of December last year. Only an hourly close and a push up above 72.06 short-term pivotal resistance level will invalidate today's intraday bearish bias to see another round of choppy corrective rebound sequence unfolding to revisit the 50-day moving average at 73.26, acting as a similar resistance level of the minor swing high of 19th of February and 21st of February. Above 73.27 potentially exposes the next intermediate resistance zone at 73.90/74.67, which is also confluencing with the 200-day moving average. So net overall, there could be some signs of a dead cat bounce. So as long as this dead cat bounce didn't surpass above 72.06 short-term pivotal resistance level that we have on the West Texas crude oil for today, we will still maintain that intraday bearish bias. All right, so that's also sum up the intraday technical outlook on the major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the data to look out for today? Right. So for today, we do have a minor light calendar in the afternoon session. So at 5 p.m. Singapore time, we have Germany info business climate indicator. So this is considered as a business sentiment indicator for the month of February. So that could potentially influence the DAX, the German 30 index, or and as well as the euro dollar. And from there, at 5 p.m., we do have a Bank of England Lombardelli speech, which is one of the Bank of England officials speaking at 5 p.m. Singapore time. And 6 p.m. we have the release of Eurozone inflation rate. So that's the finalized rate for January. That shouldn't be much of an impact because the preliminary reading could be more or less the same. That was released about 1.5 weeks ago. And thereafter, we do have a couple of key central bank officials speaking. 9:15 p.m. Bank of Canada, for those who are watching the dollar Canada and the Canada crosses. Bank of Canada officials, Gravella will be speaking. At 9:15 p.m., Bank of England, Ramsden will be speaking. Then thereafter, we have a rather quiet US session with no top tier US data to take note of. All right. So with that, that will sum up today's Daily Dose of Market Insights. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you very much.